Welcome to The Exchange, a coffee podcast where coffee people talk about coffee and things coffee adjacent. Presented by Kavoya Specialty Coffee, The Exchange is hosted by Mark Inman and Todd Mackey and produced by me, Mike Ferguson. The topic for Season 4, Episode 2 is the C market and hedging, a topic that can be, as Todd says, mind-melting. So join our hosts as they muscle through some of the complexity around the market and price strategies. If you're thinking you're not buying enough green coffee to consider hedging as an option, stay tuned through the last few minutes of the podcast when Todd talks about a new opportunity Kavoya is offering roasters for whom traditionally hedging was not necessarily an option. And now, here they are, Mark and Todd.
Welcome to The Exchange, a podcast for coffee professionals. Here with our esteemed co-hosts, Todd Mackey, and our ever-popular producer, Mike Ferguson. Guys,
Hello.
How's it going?
Good.
Hello.
Very well, thanks.
Happy to be here. Thanks for having me.
You're welcome. Thanks for having me out here in California.
Yeah, this is, to that point, we're on a new platform here. It's nice to sit together virtually.
Right. Before we get on with the topic, I've had something that's been burning away at me since our last episode, and it was called out by a listener who, where I was going off on my absolute certainty about doing hobby roasting as a business and having absolutely no numbers to back it up. And so I just wanted to spit out, for those of you who have decided to continue to listen, just some basic cocktail napkins numbers that I actually had at when we were in studio, but I got so flustered with the two of you in one room, I didn't get to it. So I'm dealing with the same roaster my son started on, which is a 1 kilo roaster that could roast 8 pounds an hour. So let's just say you were, and again, you don't have to be at the roaster all the time with this specific roaster because it was an automatic roaster. So 8 pounds an hour and 8 hours a day of roasting would get you 16,640 pounds of coffee roasted a year at $8 a pound margin. If you were making it, you would clear $133,000 in income. That's one kilo roaster. Now, of course, you could be up or down based on how much you're charging for that coffee and what type of packaging and other costings that you may have. But that's assuming a $15 to $20 a pound retail price gets you about $8 margin. If you had two of those roasters side by side, you could easily make $200,000 a year. So the hobbyist case I was making is closed. Thank you.
And you're talking about net revenue here.
Net revenue. Yeah.
Is that, but I thought what we were trying to establish is that's no longer a hobby. You're talking about 40 production hours a week.
At a 1 kilo roaster.
No, let's be very clear, Mark. You doubled the capacity quick on the fly before you said it was a couple $100,000 or $250,000 a year.
Well, I have two 1 kilo roasters side by side operating.
Yeah. So two machines. What's the CapEx spend? What is this? What is the cost of this machine?
$5,000 all in.
Okay, $5,000 delivered.
Yep.
How much to install?
There is no. It's an appliance. You plug it in the wall.
Okay, awesome.
Yeah.
Now, what is you're talking $8 clean margin? This is after
bag.
This hobbyist
stamp
pays themselves. Okay.
The rent your dad charges you on the garage?
Yeah, the garage. This is a hobby business after all. So even with the 1 kilo, let's take it there. It's $133,000. If you live in certain parts of the U.S., that's plenty of income to live on.
Yeah,
and to build a business. So
for sure,
it could be a hobby, and you could double the capacity and roast half the time. Some people go as far as having a 3 kilo roaster. That changes the numbers even more in your favor. So. So dare to dream and dream big.
Thank you, Mark. I appreciate you circling back.
So today's topic, Todd, what are we talking about?
I think we're going to lovingly, whether it's billed this way or not, we're going to lovingly refer to this episode as How to Be a Hedgehog. And that moniker is coming, of course, from our beloved producer, Mike Ferguson. Mike, why don't you lay out a little bit of your backup for why we're endeavoring to approach this episode?
No. You guys are the copy traders.
But you're the one who put us into this minefield.
Yeah, I guess let's back up a minute here. For listeners keeping score at home, and for those people that are archiving these episodes, and we'll have it up on Reddit. The topics of each show aren't Todd and I commiserating on what we want to talk about. Mike hands us a topic and says run, which I love. It's great. So he had suggested this idea of hedging in coffee, kind of the pluses and minuses or the points and counterpoints. And I always wonder where these come from, Mike. Is this just an epiphany you have on a Wednesday, or where did these
from my dreams?
Your dreams.
So over the first 2 seasons, we cover a lot of topics that would be, I think, be considered for new to sort of medium experienced roasters. And that was intentional. But this season, we definitely wanted to throw in what I think of as advanced topics for larger roasters. We wanted to sort of bigger tent in terms of topics. Not only hedging, but other strategies around purchase planning we know from our survey, our green coffee buyer survey, are things that are on the mind of roasters who are growing and looking forward to different strategies when it comes to their purchasing.
Sure. And I think this, as Todd likes to do here, he's going to throw some wrenches in the works. And I do think that there's part of this topic that can be applicable to smaller roasters as well, in both a positive and negative manner. Good topic.
Yeah, no, absolutely. I mean, you have to, luck favors the prepared, let's say, right? So you have to sort of be, even if you don't find access to these tools in your current operations, you have to become fluent to kind of grow yourself in that direction. And beyond that, we actually will be sort of announcing a new approach that we're going to be taking as a business, which is going to open these tools to what traditionally might not have been, an accessible space in terms of volume, right? I think a lot of roasters, myself included, in my experience prior to getting into the green world, I would have self-identified as someone who did not have access to this type of option, both literally and figuratively. Being that I was roasting below a certain amount of coffee. And so, Kovoya as a company, we are reorienting this side of our program to actually serve small to mid-sized roasters with options for price fixation and hedging that we'll talk about at less than container load volumes. And we'll get into that. And that's pretty exciting. So if you're a small to mid-sized roaster, don't tune out.
Right. Tune in, because there's going to be a surprise at the end that will benefit you greatly.
We're doing the thing.
Right.
And we want to break down the walls, as they say. So let's start with the question. This is hedging. What is it? What is a hedge, Mark? You're a seasoned investor beyond the coffee world. What is a hedge? How do you look at it? And then bring us to, how you would describe to a new coffee buyer what is out there in terms of a hedging strategy for, broadly speaking, someone who's in the coffee business.
Sure. So I would also frame this as you and I had a conversation a couple days ago about how you talk about this with customers, and it was refreshing to hear that we somewhat approached the conversation in the exact same way. And so to start, which, I always wonder how people talk about this, like how they pitch this idea. And I try to interject a little comedy when I do the pitch. So I'll give you the pitch that I give people. And the pitch is that coffee is priced using 2 factors. One is the market price at any given time, and that's constantly moving. And the other pricing is the differential price that whatever coffee you're talking about buying. So if you go and ask just what is the price of UGQ Columbia's today, you're going to get a differential price of a certain level. Now, if you wanted organic, or if you wanted 84 plus, or, women's grown, those are going to be additions to the differential price to get you to a larger differential price. And so often you'll hear, as if you're in the trade, and I'm now speaking to mid-sized roasters, you'll hear, oh, this is plus 70 or plus 60 or whatever the number is. And people, if they're new, they'll just nod like they know what we're talking about. What we're saying is it's plus 60 cents in addition to the market price whenever you decide to pull the trigger. So, today the market was sitting around 190. So plus 60 would be a total price of $2.50 that we're offering this coffee to you. It's the combination of the two. And so most roasters assume, newer roasters, that those two prices are in tandem and they are locked in the minute you say yes. And that's not the case. Those two prices can be locked in at different periods of time. And that's what truly hedging is about. It's using the time lapse. In a perfect world, you want to buy when the market is low and when the differentials are low. And that's rarely the case. They don't often stay low at the same period of time.
Yeah, because ultimately the original owner and seller of the coffee is paid outright.
Right.
So if I'm selling coffee originally, if I'm the original owner of the coffee, and I'm achieving an outright price and the market is very low, then relative to the market, the differential that I'm selling at would be high, right?
Right.
Ideally.
Right.
And so, the arc of time would allow you to separate those two things and take advantage of the one being low counter to the other and vice versa. But hedging is drawing boundaries around risk, right? That's essentially, you can even apply the sort of visual of a hedgerow around a house, right? You have a border that limits space. And so hedging as terminology is simply limiting or outlining risk and sort of limiting its space. So we talk about this market. You've identified diffs and why and how they relate to this market. But what is it and why is anyone using it anyway? If the original coffee owner sells the coffee flat and the final coffee buyer has to buy the coffee flat, what's the utility of this quote market in the middle, and why is it there, and why does it get to dictate so much within the middle?
Well, I mean, if it doesn't have to. If you want to deal with outright price coffee on both sides of the spectrum, in the purest sense, that is just supply and demand and what the market will bear. And as a producer, if you can get somebody to agree to an outright price that covers your cost of production and some profit and future growth, in a perfect world, I would leave that alone. The reality is that you're not living in a vacuum, and while you're trying to operate in this world, the rest of the world is operating on a very dynamic market that's moving around, and it allows within that movement opportunities to either sell coffee at higher prices if you're a seller than you would normally ask, or buy coffee at lower prices than you would normally be able to have access to. And neither party is affected by that. They all are dealing with themselves in their own bubble at that point. And so in a perfect world, you could have a relationship with a producer where they are selling coffee at a very high price and you are buying that coffee at a very low price, and you're both getting your just desserts, or having your cake and being able to eat it as well, if you understand the risks involved in playing that game.
Yeah, you cannot determine that is the outcome, but in an ideal world, that outcome is possible. Just today, I was putting together 3 containers of business where the seller actually was able to sell us the coffee at a higher outright price than the buyer was obligated to buy it because of their respective fixations.
Right.
And because of our hedge, which is effectively a equal but opposite interaction with the current holder of coffee future trade, which is the Intercontinental Exchange in New York City, we were able to recognize the appreciation of the future counter but equal to the depreciation of the coffee in this case.
Right.
Which is a little bit mind melting if I move too quickly there. But yeah, so there is this intermediary market. We talk about the market, we talk about the sea. That is a literal place. It is a literal market. And coffee has been traded in future form. So the future obligation of taking delivery of coffee and or selling coffee and delivering has been something since 1882. Of course, Mike Ferguson knows this. But then, of course, the ICE, the Intercontinental Exchange, took over in 86. Everything went digital as of 2000.
Yeah.
And now, this is something that's accessible to anyone. You can Google ICE coffee futures. You can see, all of the details, the terminal months, current trading levels, et cetera. But the reason we do this is because it allows us exactly that, right? We as the intermediary can offer the option to the seller to choose the price, the moment they price their coffee against that market.
Right.
The same, but the opposite way that we allow the buyer to.
Right.
Oh, man. No, I think this is such a heady topic.
Yeah.
And I feel like we're already like deeper in more jargony than is probably useful in lots of ways. So we're dialing in on hedge, right? We've talked about hedge as a strategy for limiting risk. We've talked about it as a border around a house, protecting the home. In this case, we're trying to draw a border around the amount of risk around coffee price. And that risk to a seller is the risk of pricing decreasing. And for a buyer, it is exactly counter, right? The risk is that price goes up. And so to what you were saying earlier, Mark, we can interact with a person one-to-one directly and have an outright price and buy outright if that supply chain is limited in scope and function. That can work. And it can be that simple.
Sure.
But often the nature of how the trade works is far more complicated.
Oh, of course.
And even just adding the dimension of time to the equation adds a tremendous amount of risk as it relates to pricing, right?
Sure.
And so one huge part of why the futures market exists is so that buyers and sellers can predict pricing into the future, exactly as the namesake, right? Futures indicates. So the tool is there. If I'm a roaster and I know that my total volume for an origin or a product is X amount, I can predict and use the instrument, right? Like the future price fixation to limit the overall change in my price, right?
Right.
Right. And that's not for the whole price of the coffee because I have the futures portion, which if I have in today's market, you said we're right around 190 today. So let's stay with that. If I have a $3 coffee total outright, I'm about 2/3 of that price is in the future.
Right.
Right. And about 1/3 is in the diff, if we look at it through that lens. So, but if I can, for next year at whatever volume I'm doing, fix my pricing and it's similar, then I'm essentially removing the question for 60% of my final pricing.
Right.
So if I have to go out and do sales at wholesale, or I have to bid new contracts, I can do that with a significantly less risk. Similarly, if I'm a seller, I can fix what 60% or, even a larger percentage of my overall price might be, with a confidence that I know, like, at least a baseline of what my revenue is going to be.
Yeah, and I would argue that the producer probably has more information because they have a better sense historically on where diffs are going to be and where, the movement of differentials, to have a very clear understanding of total price that they're going to be given for their product, versus a roaster who doesn't have that historical perspective necessarily on a differential. For them, it's still kind of the open box that moves around. And I think when you try to pitch this strategy to roasters that aren't comfortable, or this is a new world, the differential piece seems like it could be as volatile as the market. And that's outside of extenuating circumstances, COVID being one of them. It's not usually the case.
So how and why are companies like ours interacting this way and offering these options to sellers and buyers? Right? Like, why do we use these mechanisms? We have sort of built, and Mike, it'd be a good litmus. Like, we sort of built a case for why a seller would want to engage the market and why a buyer would want to engage the market, right? i.e., a seller to achieve fixation at the highest possible level within their delivery time frame, a buyer to fix at the lowest possible level within their delivery time frame. But, like, why would a Covoya or a similar company offer these options in the middle, besides the fact that it's often in the best interests of the seller and of the buyer? Why would we exist there?
Well, I would argue that most roasters of a mid to like somewhat large size does not want to go through the cost and hassle of having their own futures account through a broker, a futures broker. That ties up a lot more money to do it on their own. As if you're a smaller producer, you don't necessarily want that either. And so we allow these players to participate in our arena, and we don't really make money on that movement. We're selling physical coffee, but our collective book is large enough to allow players to come in and participate with us. I think if you're an extremely large roaster, you could have your own futures account and not waste your time with someone like us, and that does happen as well. But for people below that, it makes a lot more sense to work through an importer, to not have to have a large futures position on your own.
Yeah, and to the same end, I mean, we buy coffees and offer them spot. We essentially have our shelves at any given point with so many products on them, and we use the same risk management,
right,
hedge tools to manage, costing on our end,
right,
or to allow us to offset, if a coffee ships in March and is worth a certain price in the relative, like, global marketplace at that moment, if by the time it lands in May, say it's coming 60 days on the water from a far point, if the market has depreciated, had we the opposite, future obligation with the ICE, that would have appreciated the same but opposite amount, and we can essentially sell that coffee at the current market price without losing that value.
Right. Or even sell it at replacement cost forward, which allows you to either, recover that value, or sometimes you take a hit when you sell in replacement cost, because the coffee forward to replace that is cheaper than what you bought it for. But you understand, to be competitive, where you have to be in pricing.
Okay, so what's the most compelling opportunity, let's say, I mean, this, of course, as you engage, for any roasters listening, as you engage your importing partners, ourselves, hopefully, as well as anyone else you're working with, this is never a right, but it's a privilege as your relationships build and trust builds to have access to these tools, right? And as volume allows. But, from where you sit, Mark, what are the most compelling conversations to have from a roaster standpoint? What should you be asking about? What are the tools that present the most value in securing not only having your physical coverage, meaning like, hey, I have enough coffee that my suppliers are obligated to deliver to me that I can fulfill the contracts I have or the sales I anticipate doing to my customers.
Right. Well, so I'll give
but
you.
But also,
I was gonna say I'll give you my elevator pitch, and it's pretty straightforward. So a lot of times I'll talk to a roaster, and they'll say, "Man, the market's really low. I wish I needed coffee right now." And that usually opens the conversation for, well, you will need it a year from now, and you will need it or 6 months from now, and you can take advantage of this lower market. And then that opens up the dialogue. Also, if I see that they don't operate this way, I'll usually bring the topic up. But the topic is very simple. Let's just say you as a roaster, you go through 1 container of Colombia a year for your main stock blend, and it's something you use year in, year out. You need it no matter what. And you're watching the market and you see it go up and down and up and down, and you're trying to physically buy that coffee when the market's down and say, I want to buy it. And that is one way. The reality, though, is as the market's always trying to reach an equilibrium. It's always working hard to do that. So you'll have, if the market starts to really come down, all of a sudden you start to hear the differentials are rising because it's trying to get this threshold of cost of goods and profit. And so if you're just waiting to buy and lock in on any given day, you're basically always playing with an equilibrium. But if you needed a container of Colombia by the end of the year, and one of two things, I can offer you one of two things. One is, if the market is really high right now, I can say just buy the contract because the differentials have fallen because the market's so high. And so we're going to buy a contract, one of these containers. I got you a market level of plus 30, let's say.
A diff, you mean?
A diff. And so, but it's an unfixed contract. It's sitting wide open. And between now and when you need this coffee, you have that much time to lock in the market. Your job now is to just wait for the market level to be at a level that you're comfortable with. And one thing you need to get out of your mind is you're rarely, if ever, going to hit the bottom of the market. So that's not where we need to really focus on. What we need to focus on is where, if we fixed it, are you guaranteed to make a profit as a roaster? If you're guaranteed to make it at this level, this is a great time to call me and say, buy the futures to balance that contract. So, like I said earlier, the market's at 190. Let's say it dropped to 145 and you say, okay, let's do it. All of a sudden you have $1.75 coffee versus you could have been paying $2.20 if you would have locked it in at the 190 level. So that's one way to do it. The other way is if you see this giant drop in the market and you need that container of Colombia, I say you buy a future. So you buy the future, let's say drop to 145 again. You buy that paper contract, and you could literally apply it to anything you want between now and when that contract is due. So if you bought a December future, let's say, you have until November to take possession of coffee, early lock in a coffee. And you could sit there on the sideline. So while that market was at 145, let's say back here in March, and throughout the year it's climbing, and then differentials are falling, you could say, hey, what are prices in Colombia right now for this coffee I need? Oh, they just dropped to, the plus 30 level. Great, let's do it. So then I apply that differential to that future, And again, you bought $1.75 coffee when you could have been sitting at, 220, 230, 240 a pound coffee. And that's in a nutshell how it works. Now, I always warn people, everyone's going to say, what's the catch? Now, I'm not selling a timeshare. There's no big hook. The only catch is you have to apply this future to something, and you have to do it by the date that you bought. So if you bought a December future, you have to fulfill it before December expires, and that would be in late November. So that's the only catch. You can't say, let's forget it, or I changed my mind. You physically own a future, or you physically own an unfixed contract that at some point you have to fix. That's it. There's no other catch other than those two factors. And that is the part of the risk is there's, like you mentioned earlier, Todd, you got 60% roughly of your contract taken care of when you buy a future. Now you're just waiting to deal with the other 40% to lock it in. It's a pretty safe bet versus just buying it spot and locking it in today. You don't know, did you pay too high on a future or did you pay too high on a diff? But somewhere you probably paid too high. Now, COVID was the worst because what you had was a rising market, which theoretically diff should fall, but you had rising differentials and you had rising shipping rates. So you just got the 1-2 punch from all three sides. That's where things can be worst case scenario in hedging, and where a fixed, outright price coffee can make more sense. But at that point, you start to worry about default risk and, people knowing that they can make more money by going out in the market and selling, and you run the risk of somebody just not delivering on you because you locked it in too low.
Yeah. Or a quality risk, right? Where if I'm delivering to you at a price that's comparable to the open market, but the open market is less, has less, like quality, specificity or quality requirements, I could potentially process my coffee without as much discretion and sell more to the open market at the same price. Right. I could potentially under deliver you on quality. Comparatively, I could, deliver sample and take rejection and sell for higher elsewhere. So there's a lot of these dynamics that end up coming up in a time like that are pretty wild. Why has this historically been something the reputation of the futures market, of the ICE and its impact on coffee is really bad. Like, why, if it allows the possibility for the seller of a coffee to sell that coffee at a higher price than the respective buyer ends up buying it, and no one is missing out along the way, like, why is this bad? And that's not an implied answer. I mean, literally, why is the reputation the way it is? And is it fair? Is it as unforgiving as it's regarded to be? What do you think, Mark?
Well, I think that there's a couple of reasons why that reputation is justified. One is, the futures market is dealing with commodities, basic commodities. And I would argue, Mike could prove me wrong here, but that the bulk of our listeners are not buying commodity, exchange grade coffee. They're buying a specialty product with a lot of other bells and whistles attached to it. It could be certification. It could be cup quality markers, other things that it's not bulk exchange coffee. We're not talking about bulk sugar. It's not in that market. So the fact that the products that you and I are selling have nothing to do with commodities in the scheme of things makes it an unfair market, because it's tying a specialty product that is not sold in bulk to a market that is very much tied to large swaths of commodity. The second piece of it that I think is a fair hit is that the concentration of power is focused on New York and London and not in producing countries. And so the producers at a disadvantage because they lack the amount of market intelligence to know where things are going. And this, I think, is more true today than it was back when you were talking about the New York Board of Trade, because you have to understand the market now, the futures market is not just about supply and demand. If that were the case, then the producer would have enough information to do quite well in the commodities market. That a bulk of the futures market, or the people that are playing in the futures market, are not tied to coffee whatsoever. They're outside investment groups. There are people that are trading futures from other commodities to hedge. They could be in cocoa, they could be in orange juice, and they use coffee as a hedging mechanism. I would say 3/4 of the futures market is not tied to physical coffee. And that makes the price fluctuations random, or seemingly random, because you'll read in market reports, if you happen to read market reports, oh, coffee rose today because gold is up. Well, what does gold have to do with coffee? Well, it does, because people that are investing are moving their investments around. And so now you have players outside of the trade in the trade, and it makes it more of a casino than ever before.
Add to that the algorithmic trading impact, where autofill contracts and limit orders accelerate motion.
Well, and speed of transaction. There are people that are trying to get their computers as close to ICE as possible geographically to get their trade in quicker. So by the speed of your landline, a millisecond off could make or break profit for you. So that people are trying to be in close proximity to servers because they want the trade to happen immediately, the strike to happen immediately.
Yeah. Wild. Okay. So, all of this is good. All of this is fine. Lots of valid perspectives, lots of different positions from which to sit and look at these tools. Historically speaking, this isn't even a conversation for small to mid-size roasters, right? We kind of acknowledged that earlier. Hey, this is great. Come talk to us when you can buy a container of coffee.
Right.
Why has that been the case? And why should a small roaster pay attention beyond the fact that we're going to start opening this up to buyers of 50 bags or more?
Well, I mean, traditionally people have been locked out because a contract, a future, equals 37,500 pounds of a given coffee. So if you're buying micro lots, this is irrelevant. You're not even buying a future to do this. If you're buying even a blender grade that would be tied to the market, if you're not buying a full contract, you can't buy half of a future theoretically. So that's why it's not relevant to smaller roasters. You could argue the case that if you cobbled together an entire container of different coffees in one country, you could make that a future, but that becomes very complex, and many import companies aren't going to deal with that complexity. That would be the only real relevance where I think a smaller roaster could participate. But I have a feeling, Todd, you have some magical new but wait moment here that we're about to hear.
Well, I just mean to say, right? Like, the limit has been exactly that. It's 37,500 pounds that we would have to post against a future to allow us to play, so to speak.
Right.
So, we started years ago having to kind of cope with this in terms of managing our own risk when we would fill a container. Like, you feel as though you're playing Tetris, putting all these small nano lots together.
Mm-hmm.
But we want to the degree that we can, even for $5 coffees or more, we want to at least manage the risk of whatever the market would allow of that price, whatever futures level at any given time. That's more risk management than not if we do something. So we started to use a single future to cover multiple lots, and that's become very normal. And as buyers come into the market, and buy from a spot, hey, I'll take 5 bags of this, 2 bags of that, I want 10. We have to, of course, elect how we aggregate those purchases and sales and how we cover those or don't cover those in terms of our futures trading.
Sure.
And often, we see those impacts when we start talking about tens of bags, not just hundreds of bags, right? And as the buying marketplace, as the roasting world has become more and more fragmented, right? We have more and more hobbyists becoming small businesses.
Right.
We have more small businesses finding niche business that they're happy to do and hyper profitable and excited to operate at what would be sort of traditionally too small of levels in terms of the volume of their business, but their margins are very big, right?
Right.
So, we see offering these tools as an opportunity that, we're uniquely suited to offer, where we can engage customers that want to come in, might be up for buying 50 bags or more of coffee. And we want to offer the opportunity where they can lock that physical coffee at a differential and leave that contract unfixed, open, as you called it earlier, with the opportunity to, before the expiration of that terminal, right, they can come in and choose a price to fix that. So essentially, we're, for core customers that we have been doing business with for long enough to build trust, for folks who are ready to work collaboratively with us on, coffees that they are, sure to take with terms that, we've seen season on season that they're showing up. We want to throw out the requirement to, be a box buyer or a full container buyer. And we want to start offering these tools. So it's pretty exciting. I mean, that I understand, we're going to be the only, larger trade house that will offer this to this space. And, this is something in the coming weeks, we'll start to be talking to our customers directly about. Certainly anyone who's listening, who's interested, that threshold again is going to be 50 standard bags. So it's not accessible to everyone by any stretch, but, that opens it up pretty widely, which is exciting.
Yeah, that's fantastic. And I would say that for people listening, no matter who, I mean, as much as we work here at Covoya, as much as, I'm a competitor to other import companies, any importer that knows what they're doing is more than happy to walk you through the ins and outs of this type of transaction, whether, in futures, and assist you with all the tools you need to make an informed decision. We don't, it doesn't benefit us to get you to fix one way or the other. It does, there is nothing in it for us. We want you to win, because if you win, you're more likely to continue to buy from us. So we're certainly not in the business of steering you in the wrong direction because somehow it benefits Covoya more. That couldn't be farther from the truth. So this is a nice tool, a great tool. And for roasters that don't quite understand, you're participating in hedging whether you understand it or not when you buy coffee spot, because when you buy it, we're still focusing on a differential that we're offering that coffee for, and the price we're offering you is tied to the price of the market that particular day. So what Todd is proposing here is that we're going to break that a bit and allow you to buy the differential and fix when it's advantageous to you, which I think is a pretty cool tool for anybody who wants to take the next step in their experience in buying coffee and starting to dip their toes into hedging.
Yeah. And hopefully these, extra seasons ahead of, any growth and volume will allow for, skill development and savvy that becomes hugely a huge part of, the success of these different companies, right? Like the more seasons in the field, the better,
right?
The sooner that you can engage the tools that are really impacting the ebb and flow of trade in the space that you're operating, the better. So, as much as Mark tells you, I have to share this disclaimer, but as much as Mark will tell you on a one-on-one phone call that he knows where the market is going, where the future is going, we don't know. And anybody who would tell you is,
if that were true, I would not be working any longer. I would have already retired.
I can guarantee by the video feed I'm watching, Mark is not phoning in from a hammock on the beach anywhere.
No, nor a yacht.
Yeah.
So,
but
yeah. And when Mike is writing the history books here at Kovoya, is he crediting you with creating this strategy at Kovoya? You are the one who nudged the powers that be to allow for this to happen?
I pulled on some strings just to get a message through, but I'd actually like to shout out Charlie Requat and Lisa Collins, who are the ones who they are managing our structure and our aggregated futures position and will be the key vector for how we actually get this done. To be honest, they've been doing this as it relates to our spot trading.
Sure. On the back end.
Ongoing. So, but to open it up in a way that benefits our close customers, like our core customers, and hopefully endears us to new, soon to be core customers. I mean, I just think it's awesome. So thank you to Lisa and thank you to Charlie. And hopefully it, it allows for additional margin to be found, for folks in the biz.
I think it's incredible. It's a cool tool, and it will certainly put a lot more power in roasters' hands in a very challenging, market where on the roasting side, profits are getting harder to make, and this allows an ability to make even more money.
Here's to more hedgehogs.
More hedgehogs. Is that what we call ourselves? I mean, I would not have to address myself in that way, but yes, here we are.
Nice.
You've been listening to The Exchange, presented by Kovoya Specialty Coffee, hosted by Mark Inman and Todd Mackey, and produced by Mike Ferguson. Our opening theme music was By the Dip by Dream Protocol, and our closing theme is Good Plan by Peter Nestruck. All music is free use. Thanks for listening, and now your postscript.
I did adhere to the don't look at Todd in the eyes thing on his rider. So